I remember March 2020. My gym buddy Carlos was freaking out, checking his phone every 5 minutes between sets. His entire retirement account was in tech stocks. Nasdaq was bleeding red. Day after day, he watched his money disappear. After 2 weeks of panic, he sold everything, took a 35% loss and said he'd buy back when things calmed down. Meanwhile, my neighbour Maria, a school teacher, didn't even log into her account. She just kept her automatic contributions running like nothing was happening. Nearly 6 years later, Carlos is still trying to get back to where he started. Maria's account is up 367%. Same crash, two completely different outcomes. By the end of this video, you'll know exactly which 3 ETFs protected Maria while Carlos was panicking. These same 3 investments have worked during every major crash in the last 25 years. The 2000 dot-com bubble, the 2008 housing crisis, the 2020 pandemic. Every single time, they either held steady or actually went up while everything else burned. And when you hear about the third one, you'll understand why wealthy people quietly load up on it before every downturn. Here's what nobody tells you about recessions. They happen every 7 to 10 years, like clockwork. We had one in 2000, another in 2008, one in 2020. And we're probably heading toward another one soon. But here's the secret most people miss. More millionaires are created during recessions than any other time. Not because they're lucky, because recessions are like Black Friday for investments. Everything goes on sale. Stocks that were too expensive suddenly become affordable. And the people who have a plan and some cash saved end up buying quality assets at massive discounts. Most people do the opposite. They panic. They sell at the bottom. They pull their money out right when they should be buying more. Think about it. If your favourite store had everything 50% off, would you stay home or would you go shopping? That's what a recession is. A massive sale on wealth-building assets, but only if you know what to buy. Here's the truth. If recessions are opportunities to get rich, what should you actually buy? The answer is simple. You need 3 things: insurance for when the dollar loses value, safety for when everyone's panicking, and stability from companies people can't stop buying from. These 3 ETFs give you exactly that. Let's start with ETF number 1, gold. Specifically a gold ETF like GLD or IAU. Now, I know what you're thinking. Gold? That's what my grandfather talks about. But there's a reason gold has been valued for thousands of years. It doesn't care about the stock market. It doesn't care about your job or the economy. When people get scared, they buy gold. When the dollar is losing value, they run to gold. It's pure insurance for your wealth. Let me show you the proof. In 2020, when COVID hit and stocks crashed 30%, gold went up 25%. Not down, up. In 2008, when the housing market collapsed and stocks fell 35%, gold went up 5%. When the dot-com bubble burst in 2000 and tech stocks dropped 70%, gold climbed 22%. See the pattern? When everything else is falling apart, gold either stays stable or rises. Here's what most people get wrong about gold. They think it's an investment. It's not. Gold is insurance. What's the difference? An investment grows over time because it creates value. Apple makes iPhones. Amazon ships packages. They build, they grow, they profit. Gold just sits there. It doesn't pay you dividends. It doesn't have earnings. It doesn't produce anything. So why own it? Because when the world feels like it's ending, gold keeps its value while everything else crashes. Think of gold like a fire extinguisher. You don't buy a fire extinguisher because you want a fire. You buy it in case there is a fire. Gold is the same. It's your financial fire extinguisher. And here's the beautiful part. You don't need to buy actual gold bars and hide them in your house. You can buy GLD or IAU, which are ETFs that track the price of gold. You buy them on any stock app. Robinhood, Fidelity, Cash App, whatever. They work exactly like regular stocks. Super simple. Let's say you had $1,000 in 2008. If you put it in regular stocks, you would have lost $350. Your $1,000 would drop to $650. But if you put it in gold, you would have made $50. Not a huge gain, but you made money while everyone else was losing. And more importantly, you still had your capital intact to buy stocks when they were cheap. I know a guy who keeps 15% of his portfolio in gold, not because he thinks it'll make him rich, because it lets him sleep at night when headlines scream. That's what gold does. It's not exciting, it's protection. And during a recession, protection is everything. Here's something important. Gold prices are high right now, even though we're not in a full recession yet. That could mean people are scared and protecting themselves early, or it could mean too many people bought and the price is inflated. Nobody knows for sure. But here's what I do know. When recessions hit, gold usually protects. So if I'm wrong and gold drops a little, I lose some money. If I'm right and a crash happens, gold saves me while everything else burns. I'll take that deal every time. ETF number 2, Treasury bonds, specifically long-term Treasury bond ETFs, like TLT or IEF. I know bonds sound boring. They sound like something your parents talk about at dinner. But when markets crash, Treasury bonds are where smart money runs. Not because they're exciting, because they're safe. Here's what happens during a crash. Stocks are falling, companies are struggling, people are terrified. They don't want risky investments anymore. They want safety. They want to know their money won't disappear overnight. And the safest place on earth? The United States government. Now, you might say the government is broke. They owe trillions of dollars. You're absolutely right. But here's the critical difference. The US government has never not paid someone back. Not once in over 200 years. Why? Because they can print money to pay their bills. Does that mean the dollar might lose value over time? Yes. But they will still pay you. It's like lending money to your broke friend who has rich parents. Yeah, he's broke, but his parents will bail him out every time. You're getting your money back. A treasury bond is just a loan you give to the government. You hand them money, they pay you back with a little extra called interest. That's it. Now here's where it gets interesting. When lots of people rush to buy treasury bonds because they're scared, the price goes up. It's supply and demand. Everyone wants safety, so safety becomes more valuable. And if you already own those bonds when everyone else is panicking, your investment just went up while stocks are crashing. Let me show you the numbers. In 2020, regular stocks went up 18% for the year, despite the crash. TLT, the 20-year Treasury bond ETF, also went up 18%. In 2008, when stocks fell 35%, TLT went up 28%. During the dot-com crash from 2000 to 2002, stocks fell 37%, and Treasury bonds went up 45%. Every single time when stocks crashed, Treasury bonds went the opposite direction. My accountant told me something interesting. Every wealthy client he has owns Treasury bonds. Not for growth. For ballast, like a ship needs weight at the bottom to stay stable in a storm, your portfolio needs Treasury bonds to stay stable during crashes. You might think bonds don't make much money, and you're right. Bonds are boring. They might pay 2, 3, maybe 4% a year. Nothing exciting, but bonds aren't about getting rich. Bonds are about making sure you still have money when everyone else is broke. Here's the magic. When you combine stocks and bonds, you create something powerful. Your stocks give you growth in good times. Your bonds protect you in bad times. Together, they smooth out the ride. You can buy TLT or IEF on any stock app. Same as regular stocks. Takes 30 seconds. And when the next crash comes, you'll be the calm one while everyone else is panicking in the break room. ETF number 3, and this is the one most people never hear about. The one that quietly saves portfolios while everyone else is freaking out. Defensive dividend ETFs, specifically VIG, NOBL, or XLP. These are companies that make products people buy no matter what's happening in the economy. Toothpaste, soap, food, electricity. The boring stuff you can't live without. Here's a simple question. If you lost your job tomorrow, would you stop brushing your teeth? Would you stop buying toilet paper? Would you stop eating? Of course not. Even in the worst economy, people still buy certain things. And the companies that make those things keep making money. That's what makes them defensive. They defend your wealth when everything else collapses. Let me break down the 3 types. First, dividend aristocrats. These are companies that have increased their dividend payment every single year for at least 25 years straight. Think about that. Through recessions, crashes, wars, pandemics, every year they paid shareholders more money. If a company can do that for 25 years, they're probably not going out of business next month. NOBL is an ETF that only includes these dividend aristocrats. Right now it pays about 2% per year. Not exciting, but steady and reliable. VIG is similar, made by Vanguard. Same concept. Companies with strong dividends that keep growing. Second type, Anitsupermicro, Tied consumer staples. That's just a fancy way of saying stuff people always buy. Procter & Gamble makes Tide detergent. Do you think people stopped doing laundry in 2008? In 2020? Exactly. Coca-Cola makes Coke. Walmart sells groceries. Costco sells bulk food. People buy this stuff whether the economy is booming or crashing. XLP is an ETF that holds about 37 of these companies. VDC holds about 106. More variety, same idea. Here's the proof. During the 2000 dot-com crash, tech stocks fell 70%. 70%. Consumer staples stayed about the same or even went up a little. Why? Because people kept buying soap and groceries. Same thing in 2008. Tech got destroyed. Consumer staples held steady. The wealthy know this. That's why they own boring companies, because boring companies don't go bankrupt. Third type, and I'm only mentioning this because of what's happening in the world right now, defense companies. There's a lot of global tension. Wars, conflicts, scary headlines. And here's the uncomfortable truth. When wars happen, some companies make money, companies that make tanks, ammunition, fighter jets. All that equipment comes from regular companies and governments pay them. ITA and PPA are two ETFs that hold defense companies. I'm not saying war is good. I'm just saying if you look at the world and see rising tensions, defense stocks historically do well. Even during recessions, governments keep paying for military equipment. Yeah, here's what most people miss. You're not putting all your money in one place, you're building a toolbox. Gold is your insurance. Treasury bonds are your safety net. Defensive dividend ETFs are your stability. When the crash comes, and it will come, you'll have 3 layers of protection, while everyone else has nothing. So let's bring this together. You've just learned about 3 ETFs that have protected wealth through every major crash in modern history. Gold for insurance when the dollar loses value. Treasury bonds for safety when everyone's panicking. Defensive dividends for stability from companies people can't stop buying from. Here's what this really means. You're not just buying ETFs. You're building a financial shield. Picture yourself 5 years from now. The market just crashed. Your coworkers are panicking, checking their accounts every hour, talking about selling everything. But you're calm. You open your app and see your gold is up. Your treasury bonds are up. Your defensive stocks are holding steady. You didn't get rich overnight, but you didn't lose half your money either. And now you have cash to buy quality stocks at 50% off, while everyone else is too scared to move. Now imagine 10 years from now. That crash is long over, the market recovered. And because you protected your money during the panic and bought during the sale, your account is double, or maybe triple what it would have been if you just held regular stocks. You have options now. Real options. You can retire early if you want. You can take that trip you've been dreaming about. You can help your family. You can start that business. All because you made one smart decision today. You built a shield before the storm hit. Here's what to do right now. First, open your stock app. Robinhood, Fidelity, Cash App, whatever you use. Look up these tickers. GLD for gold, TLT for treasury bonds, NOBL for defensive dividends. You don't have to buy anything today. Just look at them. Read about them. Get familiar. Second, decide how much you can invest. Even if it's just $100, start somewhere. Here's a simple allocation. Put 40% in defensive dividends like NOBL or VIG. Put 30% in gold like GLD or IAU. Put 30% in treasury bonds like TLT or IEF. If you have $1,000, that's $400. $300. If you have $500, that's $200. $150. $150. The percentages matter more than the exact amount. Third, set up automatic monthly purchases. Let your app buy a little bit of each every month. That way you're building your shield over time without thinking about it. And fourth, leave it alone. Don't check every day. Don't panic when one goes down a little. These are long-term holds. They're your protection. Let me tell you about 2 brothers I know. Alex and Tom both got $40,000 from their grandmother in 2007. Alex put everything into a hot real estate fund. Housing always goes up, he said. Tom split his money. Half into an S&P 500 fund, half into treasury bonds. Boring, right? 2008 hit. Alex's fund collapsed. He panicked, pulled everything out at $18,000. Lost more than half. Tom's stocks dropped too, but his bonds went up. His $40,000 became $36,000. He lost $4,000. Not fun, but manageable. A year later, Tom had $48,000. His stocks recovered and his bonds stayed steady. Alex was still at $23,000, too scared to get back in the market. The difference wasn't intelligence. It wasn't luck. It was having a shield when the storm hit. Tom could sleep at night because even when his stocks fell, his bonds protected him. He never panicked. He never sold. And eventually he won. That's what these 3 ETFs do for you. They're your shield, your protection, your financial parachute. The next recession will make millionaires, not because of luck, not because of perfect timing, but because of preparation. People who own the right assets, who stay calm while others panic, who have cash ready to buy the discounts. That's who wins. And now you know exactly what to buy. Think about it. If you've made it this far in the video, it means you're serious about protecting your wealth. You're not like most people who just hope for the best and panic when things go wrong. You're someone who plans, who prepares, who takes action. That puts you ahead of 90% of investors already. Let me know which of these 3 ETFs you're planning to buy first. Gold for insurance, treasury bonds for safety, or defensive dividends for stability? Drop a comment and let me know. Subscribe to this channel for more strategies that help you build real wealth, even when the world feels chaotic. And remember, the people who get rich during recessions had a plan before everything crashed. Now you have that plan too. Thanks for watching. Build your shield, stay calm, and I'll see you in the next one.